Hi guys, welcome back to TradFi and Bitcoin Club. And today's discussion would be around 24 risks of equities. So, um, like 24 risks of equities, this is basically a chapter in uh, Treasury of Michael Saylor. And here he has talked about what are the risks that we as an investor need to take when we are investing into equities. So basically, these risks. I mean, the name of the chapter is 24, but risks can be outnumbered or not a lot of risks, or let's say if you are investing in a banking business, the risk that you take when you invest in banking business might be different when you invest in, let's say, a utility business or when you invest in a IT business. So these are most broad category 24 risks. Other than that, there are also much more risks that we need to take into account. So, as I was talking about why I am doing this session is basically I want me and I want you and whoever is attending this session to understand what are the risks that we undertake when we invest in equities or any securities which are issued by, let's say, government or let's say companies. So the idea of this session is we'll compare, like, not one to one, but I will keep talking about Bitcoin in between, how Bitcoin is kind of risk free because um Bitcoin has very less risks. Bitcoin has risks, but they are in fiat terms or in dollar terms. So price risk is the fiat term that we see, or volatility risk. Volatility risk is also one of the things which Wall Street talks about when they talk about Bitcoin. So these are some things that I need to clear when any person invests in equities or bonds or preferred stocks or any securities that are issued by a company or government. They take some risks, and I will be going through all that risks today so that we get a clear understanding of from here of what how would be the world looking on a Bitcoin standard, on a, let's say, investment on a Bitcoin standard. I am very, like, kind of interested in this particular thing, like how will the investment world look like when we are on a Bitcoin standard. So this is something that I like, that I personally like. So this would be the basic which needs to be understood. I think somebody is on mute. Can you please mute yourself?
Just a minute, I will. Yashvir is on mute.
Yeah, thanks. Thanks, SB. So the idea of the session is uh, from here onwards, this will be the base. So whenever people talk about, hey man, like you are talking about MSTR, Metaplanet, STRC, whatever, they are not equal to Bitcoin. They are equities, they are securities. So the idea of the session is to explain what all the risks that you take as an individual when you invest in equities, when you invest in preferreds, when you invest in bonds. So whenever I talk about MSTR, Metaplanet, or STRC, or SETA, or ASST, whatever, the idea is not to directly compare it with Bitcoin, but the idea is to think how a world will look like when your unit of account is Bitcoin. So that is the main idea for me personally, and I think we have talked about risks in many sessions, but we haven't talked it in a structured manner. So this would be the base for understanding risk. So whenever we go like these sessions will keep happening, and I wanted to do something structured, where structured for people to refer back. So let's say in the next session we talk about MSTR, what's happening, what's the update. So there are many people who come and say, hey man, like Bitcoin's yield is freedom. I 100% get it. But I am not trying to compare Bitcoin with equity. These are two different asset classes. So whenever going forward into the future, I talk about any other thing which is different than Bitcoin. I I hope that people understand what all the risks are they taking as an investor in a particular equity or particular bond or stock or anything. So that is the reason why I am trying to do this session. So the session is focused around equity and risks related to equity, and not let's say bonds or other kinds of investments that are out there in the market. So basically, what is equity? Equity is a claim on a business. So when I say it's a claim on a business, so claim on a business means equity investor or a common stock investor has residual claims. Now, what do I mean by residual claims? So, residual claims is basically the company or the investor, sorry, the company needs to uh, basically the company is liable to pay for board, for managers, for employees, for vendors, for regulators, for let's say some litigations that happen in courts, for customers, for the currency is something different, but let's think about this in a different thing. But and apart from this, there is a capital stack in the balance sheet. Like first comes uh, lean debt, that is some assets that a company has that has been kept as a collateral. So this comes first one. Second is subordinate. This is also lien, but this is subordinate to the first lien. Third is, let's say, what I can say, bonds. Then fourth is CBs, convertible bond. Fifth is preferreds. And 1 to 5, these guys have fixed obligations which needs to be fulfilled by the company, and if company fails to fulfill these obligations, there is an high chance that company is taken into court to declare as bankrupt. So except preferreds, all the other things uh, that are mentioned here can trigger bankruptcy for a company. So this is the main idea. Then why are people investing in equities in current time frame? So in current time frame or in current era, the real reason why people are investing in equities is because uh, for example, in FDs in India, you make around 6 to 7%. Uh, in bonds, you make around, let's say, 10 to 11%. And like risks are much higher in bonds than FDs. And in equities, you make somewhere around like 14% when you like keep reinvesting. Let's say you are getting dividends or something, where if you continue real, and these are INR terms. In dollar terms, this would be like much smaller number. So the main reason why people all over the world are in equities is because of this reason. So the main reason is, as you know, M2 inflation is around like globally it's around 7 to 9%, and in India it's roughly around 10 to 12%, take 12%. So to just beat the real inflation, that is real printing of currency, you have to at least generate over and about 12%, which these instruments fail to generate, FDs and bonds. So what is remaining? The remaining thing is basically equities, and that's the reason why people are investing in equities. Now, coming to the 24 risk categories that a shareholder takes when he invests into a company or into a common stock are as follows. So, one of the main risks that are out there is basically governance risk. Now, what is governance? Governance has a good structure, like to be specific, in there are good governance practices and bad governance practices. So there are like different kinds of like things that we can identify to see that a particular company is in good governance or a particular company is in bad governance. So good governance is basically when a company has a board, and the CEO of a company is not chairman in the board. So CEO should be separate and chairman should be separate. This is one of the good practices that a company can adopt when in the governance procedures. Then there needs to be a diversified board, like around 10 to 12 members. Apart from that, there should needs to be women participation. Apart from that, um, promoters, like there should not be promoter concentration in a board. So let's say there are 10 people in a board, 10 people. So if 6 to 7 are outsiders, which are not promoters of the company, then it's termed as a good practice of governance. So there are various ways through which governance is monitored. So this is one thing. So shareholders rely on board and management to govern the corporation properly. So these are some practices or governance practices which company needs to do, which a public company needs to do when uh, ideally public companies do this, but they have their different ways. For example, CEO also holds the chair position in the board. So all these different kinds of practices keep happening. So if you have seen, let's say, because I have studied strategy, Michael Saylor is not anymore CEO of strategy, but he is the chairman of the board. So if a company CEO is also the chairman, then that is not a good practice from a governance lens. So there are nuances that for now we do not need to go into, but yeah, there are. So here an example has been mentioned, like WeWork's 2019 IPO filing exposed founder control and related party issues, halting the listing. So what happened in WeWork's case is basically they filed for an IPO, but the IPO filing exposed a risk of, like, the promoter, which I talked about. The promoter and promoter family were having a good concentration in a board. So let's say board members were 10 and promoters were 8. So that does not make any sense. Because in any company, let's say in any company, a retail shareholder is minority. It's a minority shareholder. So board is essentially set up for minority shareholder rights. And if the promoters of the company are in majority in the board, they will take decisions which are positive for majority shareholders and not in generally minority shareholders. So this is one of the reason why like the majority in the board should be diversified and not should be concentrated in family. So this is one of the reason. And this, because of this issue, WeWork's IPO in 2019 was halted. WeWork is a company, to the people who don't know, I think it's a company of co-working. So it's a co-working space kind of company. Let's not go into WeWork. Now let's come into the second risk that we as an investor take when we are investing in equities is basically operational risk. So how good a management can operate a company. This is also called as execution risk. So how good a management can execute the work that they are doing, or how good a management can execute or operate the business efficiently. This is one of the risks. So here example that is shown is basically Boeing 737 Max grounding showed how aircraft operations and safety execution can hit shareholders. So if you remember, uh, I'm not too sure if that airplane which took off from Ahmedabad to London was Boeing 737, but it was Boeing. And like when people at that time were flying around, there was a kind of what I can say, saying which became popular is basically, if it's Boeing, I'm not going. So if these kinds of operational issues come into place, then business, like we as shareholders of that business, take hit. Because if this happens continuously, or even if this is a one-off case, this becomes a risk for shareholders. Because if people start avoiding, and as the saying goes, if it's Boeing, I'm not going, and if really people started to avoid Boeing, then we as shareholders of Boeing will get like crushed out, because we are essentially the residual claim. And if we are the residual claim, then nothing will be left for us. So this is something that we need to know. Then strategic. So strategic or tactical. This is one of the risks that is basically is into the management's hand, that they can figure it out. So strategic risk is basically, let's say a company is acquiring some business for strategic purpose. So for example, Nvidia acquires, or they vertically integrate into, let's say, energy, or let's say uh, they are currently into chip manufacturing. They vertically integrate into an LLM company. So they don't know if that acquisition will be will accrete value in the long term or not. So this is a strategic decision which management needs to take when they are running a business. This also can come into operational and execution, but because it is mentioned, we can discuss about it. So The example is bad acquisitions, weak company roll-ups can accelerate decline while diluting owners. So if you are not aware, mainly acquisitions that happen in capital markets, they are, so there are three types, like cash only, then cash and equity only. Equity only. So all these things are dilutive to the existing common shareholders. So for example, let's say A company is acquiring a B company, and to acquire that company, A company, let's say before acquisition had 100 shares, and now they want to acquire B company. So they need to dilute existing shareholders and print, let's say, 20 extra shares. And these 20 extra shares are allotted to B company. So if this merger goes through, then your ownership is 1 by 120. Now, this acquisition will be accretive or dilutive will be dependent on the decision of both companies merger happening good, and they work efficiently when they merge. So the idea here is both companies were operating their businesses, but management saw that, let's say, if we acquire this B company, we both might be able to work in tandem, and there will be some strategic efficiencies that we can do, and because of that, like, our business in the long term will reward our stakeholders and shareholders. So this, like, this is not certain. This, time will tell, like, how will this decision go, and if there is a history, like around 60 to 70% of M&A are like dilutive, or like no profit no loss kind of situation for shareholders. So then the question comes, why does M&A activities happen? So one of the answer is, uh, there are incentives for companies management. If they acquire a particular business, or if this merger goes through, they have some incentives, let's say warrants or RSUs, which they will get if this merger goes through. And one of the reason why we see M&As going, even if there is a history of 60 to 70% of M&As fail in 2 to 3 years. So this is the reality that we need to take into account. Then fourth risk is basically financial. In financial, there I think we could think a lot of risks in financial, as a, so financial is a category, and then we can try, like, we can draw arrows and we can identify a whole lot of risks that are there in financial category. So for example, counterparty risk, then we have credit risk, then we have like issuer risk or banking risk. There are a whole lot of risks that come under financial risks. So here example that is discussed is Silicon Valley Bank showed how treasury concentration and duration exposure can become cash crisis. So if I remember it right, Silicon Valley Bank crashed because there was asset liability duration mismatch. So on the asset side, they were long duration, but on the liability side, they were short duration. So because of this, what happened? The short side liabilities which they had, they came due, and they could not be able to refinance that short duration liabilities, and because of that, they went bankrupt. So this is one of the thing. Now coming into the next part, external risks that a company has. So competition risk, what happened? Okay, the pencil has stopped working. So no worries. So what is a competition risk? So competition risk is basically a risk which, um, let's say for example you are Asian Paints, and the paint industry, this is back when I was investing into stock markets. So at that point in time, there was this new paint company called JSW Paints. They were just started to come into the market, and before that the market was basically monopolized by some top two to three players. So let's say Asian Paints, Berger Paints, and Paints. And Asian Paints and Berger Paints were the top two. Nerolac was there, but it was like at the third position, which did not had a much larger market. But all of a sudden, there was a new entrant into the market in the paint industry, that was JSW Paint, and it had a good backing of investors. So when I say it had good backing from the investors, this is already big company. So to the people who don't know, JSW Steel was already a big company, and they basically started a new branch in JSW Group as JSW Paints. And because of this, what happened, the so let's say in the paint industry, Asian Paint had, let's say, 50%. I'm not sure about the exact numbers, but let's say Asian Paints had 50% market share. But because of this new entrant, the monopoly which is already there, the risk is for them, because the new entrant will put in a lot of money, do advertising, do marketing, and try to gain market share of the paint industry. And the one of the key losers here was Asian Paints and Berger Paints, because of whatever things that happened. So when a new entrant comes into market, whatever services or whatever goods that you are offering, suddenly a new player comes in and it disrupts your business. So, or let's take an example of Geo coming into the telecom sector. So Geo came in and it disrupted Vodafone. Like there were hell lot of companies which were offering telecom services. So if I can remember, there were around 10 12 companies out there. So Jio essentially destroyed 7 to 8 companies, and now in the market there are only 3 to 4 major players which are remained, and of that four also only two are major, like Jio and Airtel. Apart from that, BSNL is, because it's government entity, it's surviving, and there is one more, Vodafone Idea. So it is also kind of in the survival mode. So whenever a new entrant comes in, it's a great competition risk that comes into, and it takes your market share. So here an example is talked about. So first, let's define competitive risk or competition risk. A better or cheaper product can erase a position that once looked defensible. So once a company could have a moat, but a new company which has better offerings, better goods, better services can disrupt your existing company. So in the US, Walmart and Amazon, like they were two big competitors. Like Amazon was basically on the online side of things, and Walmart was in the offline retail space. But uh, Amazon also started to have their own Walmart type stores in the US. So it started eating the market share of Walmart. Then comes the sixth risk, or second risk in this page, is basically technology risk. So all of a sudden, a new technology emerges and it wipes out the existing businesses. So for example, um, Kodak invented digital imaging. So whatever photos that you see in our mobile phones, that was invented by Kodak, but they did not like did a lot of research in here, and they remained behind and their film business. So to the people who don't know, I think most of us might know this, but in let's say early 2000s or late 90s, I'm not that old by the way, but I know this because I in my home uh, there like my grandfather has a camera, and it has a roll which is called a film. So whenever you click picture in that camera, that film gets something, and that film needs to be sent to photographers to be dyed into a specific detergent which will then come out. So it was a long process. So digital imaging destroyed or disrupted the business of films. So this is a technology risk that you take when you are investing in equities. Then political risk. So uh, if you are like, let's take the name. I like everybody knows this. So Adani's and Ambani's like people speculate that they have good connections with the government. uh, okay, this is something different. I diverted. So political risk is basically coming from a regulator, or you can call it a regulator risk as well. I think I diverted somewhere else. So political risk is basically government bringing something new law or something which can disrupt your business. So an example is given. Airbnb supply in New York shrank when city policy tightened short-term rental rules. So to the people who don't know, Airbnb is a kind of business which lets you, if you own a flat or if you own a house, you can list it on Airbnb for let's say 1 day, 2 day, 3 day, and charge like something less than hotels, or maybe if that property is great, you can charge more than hotels. So it's basically you can use your space for short term rentals instead of traditional rentals, which are like you find a tenant, and that tenant lives in your flat for 1 or 2 years. So in this case, in Airbnb case, it's short-term rental, and in New York, something happened where they changed the laws in the city, and because of this, um, all of a sudden, um, Airbnb's business got like hampered. Then facilities. What is this thing? Factories, venues, ships, mining sites can be trapped inside hostile jurisdictions. So this risk can also be called as jurisdiction, or let's say a country specific risk. So these risks are higher in unstable countries. Jurisdiction risk. So these risks are higher in, sorry, in developing economies, because in general, if you see in developing economies, governments are unstable. Or let's take for account like African nations. So their stability of government is literally nothing. So I remember when I was trying to do mining, there is something called miner hosting. And in Ethiopia, because they have a good amount of hydroelectricity power plants, the electricity rates that you get in Ethiopia was around 0.02, or let's say 2 cents per kilowatt or something per unit of electricity, which in my place in Maharashtra is somewhere around 0.15, or in the mining case. So this is basically great difference that was there. But because these miners were hosted in an African nation, please don't take me wrong. Like, I'm not saying that the people of this country are bad or nothing related to the people. I'm talking it from a perspective of government risk. Like, we all know African nations have military rule, or they have dictators, or and they do not have investor protection rights in their country. So because of this, I dropped my idea of like buying that minor hosting back then in I think in 2023. But this is like a good like it was a great investment opportunity. But I thought that if some dictator thinks that, hey man, what are you doing? What is this Bitcoin thing? I am like not allowing you to do this. This is making noise 24/7. What are you doing? And if this thing happens, then basically my investment will drop down to zero. So this is one thing. This is jurisdiction risk or facility specific risk. So here also the example that is mentioned is China's 2021 Bitcoin mining crackdown forced miners to move machines or abandon capacity. So miners have to either abandon, like mark down their investment to zero, or they have to move out from China to, let's say, Mongolia or Russia or neighboring nations where cost of electricity is pretty cheap to run the business profitably. So this is one thing. Now, coming into the other risks, the corporation depends on permissions, people, suppliers, and buyers. Now, here I talked about political, also similar to regulatory. But here again, we are seeing regulatory. So these two now in these 24 risks, I need to say this, like there will be some risks which you will see that these two risks are somewhat similar, but this is how people define, like it depends on your definition, like how do you define a particular risk. So here in the political risk, the definition that has been given is local, national, or foreign authorities can zone, ban, sanction, or constrain the business. And in the regulatory, rules are numerous, mutable, and hard to comply with perfectly across jurisdictions. So this is also somewhat similar. So I do not need to like waste a lot of time here. But example that is given is basically banks after 2008 had profitability reshaped by capital, liquidity, and compliance rules. So regulator made some drastic changes because it caused 2008 financial crisis. So after that, regulator changed some policies, and because of that, it changed the direction of banking industry. Then comes employee risk. Now, what is employee risk? Every employee can create civil, criminal, contractual, or reputational exposure. Wells Fargo's fake account scandal turned frontline incentives into fines and management change. So, employee risk is basically, let's say, your top management. Top management. If you remember our banking video, which we discussed or which we had um, this what short film by Varun Sukhraj, which we talked about. So the examples in that case are highly can be we can take that an example. So the top leaders of particular bank made some decisions to lend it to like big corporates, which created concentration. So they so for example, HDFC is a bank which is retail oriented. So when I say retail oriented, a good amount of their loan book comes from retail loans. So uh, it is seen in the banking industry that retail ideally do not default, and even if retail loans default, um, like there will be it will not affect a company on a higher level. But let's say your loan book is concentrated in 10 corporates. Then in this case, if top two corporates defaulted, then your banking business is at risk. Maybe it might go to bankruptcy. So these are some things that it will also. Now one risk can also come into different categories, like, so employee risk is can also come under execution risk, can also come under operating risk. So it is not that a single scenario or a single situation comes rightly under employee or rightly under vendor or customer. So like one scenario can be in different levels of risks as well, or it can be both of the risks. So in ICICI Bank's case, it was also employee risk, it was also governance risk, it was also uh, execution risk. So all of these things need to be taken care of. Then vendor risk. So utilities and telecom providers can shut down operating capacity faster than lenders can. A miner with single power utility can become uneconomic the day electricity rates are reset. So what is vendor risk? So let's say you are sourcing materials for your company from a single vendor, and that vendor increases cost by 10% or 20%. So in this case, your company right now takes that 20% risk, 20% cost, increasing cost risk in the business, and it depends on the company's position that it can transfer that cost to the customers or not. So this is one of the thing that we should take into account, that vendor risk is that we should take a look. So if you are a manufacturing business, let's say you are sourcing raw material for your business, how many different, or what is vendor diversification that you have, or your raw materials are highly dependent on let's say China, so, or vendors in China. So in case of India China clash, there will be something that government will say and your business will stop. So this also comes under vendor risk, this also comes under geopolitical risk. But yeah, I'm giving some random examples that I can recall as I am going in the session. Then comes customer risk. So again, when I say customer risk, uh, let's say your customers are top 2 to 3 clients, or for example, Indian IT companies have customers in the developed world. So in the developed world, for example, Infosys or TCS, they do some back end work for the banking giants in the US, or some pharma giants in the US. So they do some IT backend work here sitting in India. Now let's say, for example, a hypothetical company has a customer base of let's say they have 5 different customers, and because they have higher concentration in these 5 different customers, and one customer switches to another IT company which is offering them good conditions, or let's say cheaper rates or a better service. In this case, if that customer was contributing 10% of the revenue, you will right now take 10% hit on your revenue. So when you are analyzing company, you have to assess what are customer risks that you are taking. So Walmart or Amazon can squeeze suppliers' price, then learn enough to private label. Now, this is something very different that I explained in my example. But yeah, let me talk about this. So this is also a type of customer risk, but here what they are essentially saying is, let's say I'm selling fans and I'm selling a particular type of fan. Let's say that fan is BLDC motor. It has a remote. It can be controlled with a remote. It is also controllable with Wi-Fi, Bluetooth. And now uh, because everybody is buying on Amazon and Flipkart, they have customer data. What kind of fans or what kind of refrigerators or what kind of ACs customers are buying. Now, what they can do is literally copy and paste the specifications to a particular manufacturer and ask that manufacturer to privately manufacture it for my brand. So, for example, there are brands in case of Amazon, it is Basics, Amazon Basics. In case of Flipkart, it's Marq. In case of Zomato, it's its own Cloud Kitchens. So these platform businesses, as and when they collect enough amount of data, they start to do their own. They start to build their own products. From a capitalist perspective, there is nothing wrong, but from a government and regulatory point of view, I think government put a lot of restrictions to Amazon and Marq and even Zomato in some cases, that you cannot use the user data and like manufacture your own white label products, but it still happens. I think it's 8:52. I need to rush. A company is an economic creature. Everything in the world wants to kill it. So yeah. Now there are other risks. Even a well-run company can be repriced by the world around it. So reputational risk. One wrong decision by the management can cause reputation. This is a reputation risk. War risk. If a company is in a specific area, let's say companies in Russia, Ukraine lost routes, plants, and markets because of like the war. Basically, their business got shut off. Then, for example, US whatever outlets like McDonald's and other all other outlets, they came out of Russia in the war. Although it was not because the business was not going good, but it was because US government put a lot of restrictions. But essentially, it was because of war between Russia and Ukraine. Currency risk. Now, this is a very good example is for TCS. So for TCS, they earn in dollars. They earn in dollars. So if rupee depreciates in comparison to dollars, it is good for the company. But if rupee appreciates, uh, so if from 95 it goes back to 90, then for whoever is exporting their services, it's bad for that company. So to hedge this, they need to hedge currencies via like in the derivatives market. Then tax risk. So there is always tax risk. Like we don't know, like whenever government can literally change taxes. For example, they can change GST rates. We government keeps coming, keeps like bringing new and new GST rates whenever they want. So if your product or product category is shifted from lower GST rate to higher GST rate, now it's not good for your business. This is tax risk. Then equity lives inside weather, borders, contracts, and codes. So what is weather? Now, weather risk. Imagine a oil drilling or oil mining company, or a company who is pulling out oil from way, oil grids which are located in seas, high seas. And if weather is not good in that particular area, then that will affect your basically capacity to uh, pull out oil from the bed. So this is one of the weather risks. Then other weather risks are, let's say, so not earthquake, let's say hurricanes or more rainfall. So the basic weather risk is basically businesses which are related with agricultural sector. So if rainfall is not good in the country, the sectors related to agriculture, like like let's say tractor manufacturers, they will take a hit because rain is not happening, farmers will not produce, and there will be less demand for tractors. So this is one kind of things. Customs. So custom risk is basically this Trump thing. Trump randomly increases tariffs, decreases tariffs, and whatnot. So I think people are aware of this customs risk. Legal risk. The company is bound by what employees do, sign, disclose, produce, or fail to prevent. So the example is Volkswagen's emissions conduct bound the company to investigations, settlements, and oversight. So if I remember the case right, Volkswagen came under sorry, BS4 is basically our standards, but it happened in Europe, I think. So they basically they whatever European standards, they didn't met that standards, and they mentioned that they are meeting in paper. So it was a legal risk, a legal risk. Then tort risk. What is tort risk? Products disclosures decisions can trigger class actions, derivative suits, and claims. Ford Pinto litigation made rear impact, fire risk, a classic product liability case. So it's a particular product risk. Now, by reading example, you can also think of it as a legal risk, but it's specific to that product. And if something that is not right with that product, it can create tort risk. Then residual risks are still human, legal, and temporal. So what are these? Patent, health, life cycle, and succession. So let me come to succession. Succession planning. You might have heard of this word, succession planning. You might have heard that Mukesh Bhai is planning planning his succession because whatever has happened with Reliance after Dhirubhai Ambani, there were a lot of court matters and which took place between Mukesh and Anil. So he learning from that. He's right now only planning succession for Anant and what is the other name? I'm forgetting. But let's not focus. You got the point, right? So this is basically after a demise of a critical figure, um, there might be internal conflict and successional risk can happen. Like, for example, Anil Ambani, when Reliance got separated, Anil Ambani basically got very great businesses. Like he got telecom, he got other tech, the businesses which had tech in them. So he got basically new kind of businesses, but because of wrong, I would not say wrong succession. It again comes into like basically execution and all other things which we discussed throughout the session. So succession is basically your successors will not fight for the particular business, that is succession. So GE after Jack Welch showed how a successor era can expose different capital allocation and risk tolerance. So control can pass to successors with different skill, temperament, incentives, or time horizon. So this is one thing that businesses need to look into. Let's take an example of strategy. So strategy, currently people discuss about key man risk, key man risk or key person risk. What after sailor? who is leading the company. So people talk about Wong Lee, people talk about CJ and other basically leadership which is there in the company. So this is something similar to succession. Then patent, coming now to patent holders and litigants can extract value without producing an operating product. NTP's patent suit against BlackBerry forced a large settlement under service shutdown pressure. So if your company has a patent, now whatever that has been discussed in this example, if your company has a patent and that patent has basically some other company has made a similar product, but they forgot that you had the patent for that particular IP, and the company who has patent, they can file a legal suit for that thing, and they can generate money. So this is patent risk. Then health risk, key leaders age. Now this is also similar to key man risk. So example is Apple Steve Jobs medical leaves made CEO health a direct investor concern. Then life cycle risk. Now to the people who don't know, a company's life cycle is something like an S curve. So do not go with my drawing, but in the initial case, the growth is, in this case, the growth is flat, but business is kind of developing and they have hope. In this phase, this is A, this is B. In this phase, the growth is picking up, revenues are increasing, and uh, basically the rate of growth is very high. This growth is happening, but the rate of growth has slowed, and in this case, uh, business has come into maturation phase. Maturation phase. So when you are investing in a particular business, you also have to take into look like on what stage of a life cycle a particular business is. Now, let me come into Bitcoin aspect, like why I tried to talk about Bitcoin. And when you are investing in equities, you take a lot of these risks which I discussed, and on top of that, I would like to talk about in specific to Bitcoin, counterparty, which came under financial risk, counterparty risk, then custody risk, custody risk. Again, what can I think of? Execution and management. These kind of risk will come in when you are investing in strategy. Then key man risk will come. Key man risk. Then what I can think of. Um, so basically, these are some kind of risks that you need to take into account when you are investing in equities. But in case of Bitcoin, if you are not concerned about the price, and if your Bitcoin is in your self custody, essentially you are not taking any kind of risk, and that is the reason why people call Bitcoin as risk free asset. Risk free asset. But if you are concerned about the price, then there is price risk, there is volatility risk. Now, the risk that I'm talking into is basically wrench, wrench attack, wrench attack risk. So, whatever asset you own has some kind of risk, and when people say that it's risk free, they are neglecting some things, or they are thinking that people know these risks, and hence they are calling it as risk free, or they are comparing it to a product, or it to another asset which has way lot more risk than Bitcoin. So when they say Bitcoin is risk free, They essentially say that when you are investing in equities, you are taking a hell lot of risks. So because Bitcoin is a bearer asset and nobody is issuing, there is no CEO, there is no board, there is no vendor, no customer, no legal entity. Bitcoin has nothing like it's a protocol, and because it's a protocol, whatever a particular jurisdiction does, it might affect in the short term, but in the longer term, I think the protocol will keep continue to get adopted, and in the longer term, risks are pretty less when you compare it to other assets which are there. One more risk that I need to hack risk. So your bitcoins in your self custody, if you are not very great at managing your 12 or 24 wallets, then maybe if you are self custodying in your software wallet, then maybe that wallet gets hacked and some things happen. So these are different kinds of risks that might come into picture. What is the comparison is not versus business versus asset, it is operating dependency versus protocol dependency. Before allocating a dollar to equity, a stored value, ask what can impair the claim. So basically, this is the essence of all the discussion that we made throughout the session. Okay, thanks. Floor is open for chat.